Hi, everyone. We're live here today to talk about CalHFA's Dream for All program. I got Holly McDonald with Compass Real Estate joining me today. It's kind of the talk of the town being, I guess, the state, because the portal actually opens up today as well, right, Holly?
Yes,
Yeah.
the Dream for All program is here, and so many people have been wondering and have so many questions about how they can qualify.
That's right. Yeah, it's a short window. It's open for 3 weeks, so we planned this, specifically for today.
Yes.
Because today is day one, and we're just going to cover the topics regarding how do you apply for this. How do you? What are the qualifications? What standards you need to meet in order to enter the lottery, and then ultimately see if you get picked.
And see if it's something that you really want for yourself or not, because there are pros and cons to it.
Yeah, there's always pros and cons. It is probably, that's why it's a lottery system. It's probably the best option out there for down payment assistance, because they do give, quite a bit, up to 20%, which we'll discuss.
Yes.
And so let's dive into it.
Awesome. Yes. So we're gonna hit you up with some of the main questions, and I think we kind of already introduced ourselves, but I'm Holly McDonald, and I'm a realtor at Compass, and I'm Jason Thomas here.
That's right. Yep, I'm Jason Thomas, mortgage advisor with JMJ Financial. JMJ Financial is on CalHFA's approved lender list, so that's one of the requirements, is obviously speaking with a lender who is CalHFA approved, so that you can apply for this, which is something that I can definitely help you guys out with. And we got a lot to discuss here, so let's get into it.
Yes.
So Dream for All, it's a down payment, it's a shared appreciation program that CalHFA is offering up to 20% down, or a maximum of $150,000. So if you want to do 20% down with this program, the maximum purchase price, for example, would be $750,000. You don't have to do 20% though, so you can still go higher in purchase price. It's an equity share on future appreciation. So Holly, is that something that, for a buyer, they're gonna be like, what is equity share, right?
I think a lot of buyers would really like to know how that works.
Yeah.
So how does it work? So when you eventually go to sell your home, this is not like free money being handed out to you. You do have to repay it. How does that work?
Yeah, so it's a loan. It's a silent loan. You don't make a payment on it. You don't pay interest on it. But you do ultimately pay back a portion of the equity gain on the property sale.
So the full amount that you borrow, so potentially 20% plus a percentage of the equity that the property earns.
Correct. Yeah. So the loan that they give you, like let's say you got $100,000, which we'll have some examples for that as well.
Yeah.
But it'll be that plus a shared appreciation. So just think of it as, hey, they're loaning you this money for free, essentially up front, with the assumption that they're going to share in the appreciation that you gain from the home for as long as you own it. It is a lottery selection as well. So.
What does that mean?
Yeah, it's not a guarantee. You do have to apply. We're within a 3-week window right now, with today being day one, and it runs through March 16th. So it's not first come, first serve. You could apply on the 16th and have just as good of a shot. I don't recommend waiting for that long.
Yeah.
In case there's any hiccups with your pre-approval with your lender. But whether you apply today or on the last day, everybody goes into the lottery, and then it's just a random drawing.
Is there anything extra that a buyer would have to provide to get qualified up front? Because already it's a big process for people to get approved, a lot of the time just getting all their paperwork together. But is there anything that people should have a heads up on that they might need to have?
It's going to be standard documentation as far as getting pre-approved, which a lender, once you speak with a lender, they can let you know what you need based on your own personal situation. And then there are some other first-time homebuyer requirements that they'll need to meet as well, along with certain citizenship requirements.
Okay, and we'll get into that.
Yeah, and we'll get into all that as well. So.
How do you qualify?
Yeah, it's so here's the thing. It's a purchase-only program, so you can't already own a home, right? You're not going to be doing this for a refinance or anything like that. I think we're waiting for the slide to come back up here real quick. There it is. I mentioned it's a first-time homebuyer program.
Yeah.
So all borrowers, so if there's a couple that's purchasing together, all borrowers have to be first-time homebuyers. There's a specific definition for that.
Yes, let's explain that.
Let's talk about that, because there's going to be twofold here with the first time thing for CalHFA. So a first-time homebuyer is somebody that has not had ownership in a primary residence in the last 3 years. All borrowers on this loan will need to meet that criteria, right? So if you are currently on title for a home that you are living in, then you know that you wouldn't be a first-time home buyer. You can own an investment property if you did not live in that investment property in the last 3 years.
Okay.
So little distinguished thing there. All borrowers are going to need to occupy the property as their primary residence, of course. This is not a program where you can get the down payment assistance to start investing in real estate and not live there. This will be primary residence. If there are multiple borrowers on the loan, there's the second first-time requirement, which is first generation, which tends to throw everyone off as well with that. It is a little bit stricter of a guideline. First generation meaning you cannot have had ownership interest in a primary residence in the last 7 years, and your parents cannot currently own a home. So I know that's going to probably unfortunately disqualify a lot of people potentially. There's different situations or different questions that people may have. For those that are watching, feel free to ask questions. Any situations or questions that you've had from people in regards to, well, what if my parents are no longer alive, or I don't speak with them, or anything like that? Have you gotten any questions about that?
Yeah, so questions about that, also questions about parents that might be divorced and maybe one doesn't own anymore, but one really does own.
Yeah, so in that instance, whether your parents are divorced or not doesn't matter, because they still are your parent at the end of the day. So if one of them owns a home, unfortunately, it disqualifies you from the first generation status.
Okay.
Keep in mind, again, if there's two people that are purchasing together, only one needs to meet that criteria.
Okay.
If your parents have passed away, they just could not have owned a property at the time that they passed.
What if they passed more than 3 years ago?
That does not matter. If they
More
owned,
than
yeah,
ever. More
yeah.
than
There's no
ever. Okay.
timeline on it. Yeah, if they owned at the time, then it would disqualify from that.
So you'd be first generation
Yes.
and first time buyer, or at least within the last 3 years.
Yep. So one needs to meet the first generation. So no ownership in 7 years, and parents do not currently own a home.
Yeah.
And then the other would need to be first time buyer status, which means they haven't had ownership in a primary in the last 3 years.
Okay.
Yeah.
Okay.
So true first time, hey, we've never bought a home, and my parents have never owned a home, you're probably good, right?
Okay. Now what about you as the buyer and your citizenship status?
Citizenship status, yep. You either need to be a U.S. citizen or be a permanent resident.
Okay.
Okay. So non-permanent residents, unfortunately, aren't going to qualify for this program, but in many instances, permanent residents, you'll be okay.
Okay. What about the income limits? Are there income requirements?
There are income limits. Yep. This is not for somebody making $1 million a year and wanting, quote unquote, free money for a down payment, right? There are income limits, and they do vary by county. This is a statewide program. We're in Southern California. We're not going to get into every single county, obviously.
Right.
And it does vary depending on what what the average income is there. But Orange County, for example, the income limit is $216,000 annually, and that's going to be combined household income. So that actually comes out to $18,000 gross per month.
Okay.
So it's going to get you, depending on your qualification, you're going to be able to qualify for a pretty sizable amount potentially, right? So the income limit, it's not super low. For example, the area median income in Orange County is $136,600. So it's about $80,000 more than that. So it's pretty generous in that regard. LA County is 168, Riverside 164, San Bernardino 164. So those are a little bit lower. Generally, Orange County is priced higher for the average home, right? Than some of these other counties. So you can still buy, quite a bit of home potentially, even with these income limits.
And now with the potentially the 20% down payment assistance, so that chunk of money, what is the cap on it?
The cap is $150,000.
Okay, and what can you use that $150,000 toward?
You can use that towards the down payment and or closing costs. And actually, we'll have a few scenarios that we can discuss in regards to good ways to structure it.
Yeah.
Because you will have closing costs on top of your 20% down. You know, if we have a slide that goes into the first generation here a little bit more too. You know, just to finish my point though real quick, there are closing costs obviously on top of it. So if it's truly a buyer that doesn't have any money, there's definitely ways to structure it where they can still get into the home without really anything out of pocket if they get selected for this.
Wow.
Yeah.
That is a good opportunity for some people, absolutely. But the qualifications are strict, and so asking a little bit more about the first generation. We talked a little bit about the divorce. We did talk about the owning an investment property. So you could own another property and not live there, and you would meet the requirement as long as none of your previous family members or parents have owned a property.
Correct. Yeah. Yeah. It's primary residence that defines this first generation or first time home buyer status, right? And that's the same thing with traditional loans as well. Whether or not you're a first-time home buyer, like if you've been renting your whole life, but you own an investment property, and then you're finally buying a primary, you're still a first-time home buyer from that perspective.
Nice. Yeah. Okay.
Let's talk a little bit about the shared appreciation that we touched on in the beginning.
Yeah, I think this is really good for people to understand.
Yeah, because this is the part that's a little, it can be a little complicated.
Yeah. It's not, you got to be careful with a free gift just to understand, you know, how it comes back around. So shared appreciation, it's just that you're sharing in the appreciation with CalHFA. As an example, like let's say somebody were to buy a home for $500,000 and you get $100,000 through this program towards the down payment and closing costs, right? There's your 20%. And you know, the home appreciates to $600,000, for example. It's gone up $100,000. CalHFA gets a 20% share in the appreciation. Okay. So you go to sell your home, you sell it for $600,000. You have to repay back the original loan of $100,000 from the down payment, plus 20% of the appreciation. In this instance, it appreciated $100,000, so that would be another $20,000. So the borrower will be paying CalHFA back $120,000. Okay, but they're coming out ahead $80,000.
They're coming out ahead $80,000.
They didn't have to pay rent.
You didn't have to pay rent. They're also coming out ahead for however long they were in the home and they were paying down the mortgage.
That too.
Right, through amortization.
That's true. Yeah.
So their total, you know, that they might be getting back potentially could be more, just depending on what the situation is, how long they were in the home.
It's a great opportunity for people.
It's a really great opportunity, also, if you are under a certain income threshold, which 80% of the area median income, then the shared appreciation drops to 15%. Okay. So, as an example, I think I mentioned earlier, Orange County is at 136. Yeah. 600 is the area median income. 80% of that is a little over 109,000. So if you get selected for this program and your qualifying income is under 109,000, then your shared appreciation that you'd be paying back is 15%.
So you get a little bit of an added bonus. Yeah.
So in the same example we just gave, instead of paying 120 back, you pay back 115.
So you earn 5,000 more. Okay. Yeah. And so I know that there are some people that say, you know, this whole profit sharing or, you know, appreciation sharing, equity sharing, it's like it's not really that benefit. It's not that good, right? Because you're not getting all of it. But when you do look at it from the viewpoint of this is allowing some people who qualify the opportunity to get into a home, they're still going to come out ahead. That's always a positive. But what happens? I mean, we're not expecting the market to go down, but what happens if the market goes down and you know they need to sell and they still have to pay back? What happens then?
Well, I mean, it would be similar. I mean, if it really significantly dropped, I mean, you're kind of in the same boat that anybody that buys is if they're going to be selling at a loss, right?
Yeah, I would imagine that the program is banking on values going up.
Yeah, yeah. I mean, you are still paying down your mortgage. So really, I mean, it depends. If it was like a year later and you've barely paid down your mortgage in 12 payments,
yeah,
and you're trying to sell the home and you're selling it for the same amount and you're needing to pay, commissions to realtors and seller closing costs and all of that, yeah, you might be, you might be losing money on the investment, right? That's always a possibility.
Yeah.
But I mean, if it's 5 years down the road and it's still worth the same amount, but you've been paying into the mortgage for 5 years,
yeah,
probably not upside down on it when you sell. May not have been like the greatest investment, but at that point, you're no worse off than if you were renting for 5 years.
Totally.
Right.
So I have a couple of questions that I've heard too. So what happened? Is there a requirement on how long you have to stay in the home? And is there a requirement on, do you have to stay in it as your primary residence? I know you have to move into it with the intention of it being a primary, but in a year, could you rent it out?
It does need to be a primary residence.
For the life of the loan?
Yeah, otherwise, I don't know what the verification process is and how they would determine that necessarily, but I would imagine it's something about, they could call the note due or have you refinance out of it and pay back CalHFA.
Okay.
Essentially is what it would be.
So you got to remain in it as a primary, sort of, I mean, which is pretty common in a lot of the down payment assistance programs.
Yeah. And I'm sure there are people that are out there that move out, right, and rent it, but I mean, that's the idea at least.
Could you have somebody move in with you?
Yeah, I mean, you could have someone move in if you're still living there. I don't see why not. I mean, they're not obligated on the loan or title, right? So that shouldn't be an issue.
Are there any restrictions on the type of property they can buy?
It's going to be like their standard, condo. I mean, they have their guidelines, but it's a conventional loan at the end of the day, so they're also following Fannie Freddie guidelines. So any restrictions that Fannie Mae, Freddie Mac would have is what you'd be restricted to. But condos, single family, et cetera, is all fine.
Yeah.
And then there is a max repayment, by the way, with this shared appreciation.
Okay.
So I think that's something that
please explain
that we should discuss as well. It's going to be 2.5 times the loan that you get from CalHFA.
That's the maximum.
That's the maximum over the lifetime of the loan.
Oh, so if you're there for 30 years.
If you're there for 30 years, let's say, and you bought something for $500,000 and you got a $100,000 loan, your max repayment is going to be the loan plus 2.5 times that.
Okay.
So it would be $250,000. In shared appreciation is the max plus the original loan.
Not bad.
So $350 total.
Not bad if your place goes up to $2 million and you bought it for $500.
Yeah, if your place went up to $2 million and you bought it for $500, you appreciated 1.5. 20% of that would be $300,000, but they're capping you at $250.
Amazing.
Right? Yeah. So
ride it out.
Yeah. So you could ride it out and then you'd be totally fine. But you can see it would have to go up significantly for you to even hit that cap.
Yeah.
And then once you do, if you've hung on to the property for that long, that would be the max that you would pay out ultimately at the end of the day. So in that circumstance, you're paying $350. Your home went up 1.5. That's $1,150,000 in equity that you gained for yourself.
Yeah, run that through a calculator on compounding. That's fantastic.
Right. So there's the max and doesn't just go up forever. Another question that we get is, when does this loan need to be repaid? Right?
Yeah,
so
when?
The nice thing is, as long as you own the home and you're in the loan, you don't have to repay it.
Okay.
You will repay it if you sell the property, as we discussed, right?
Yeah.
And that's where the shared appreciation comes in. Refinancing, if you want to refinance your loan, if rates have dropped, you do get one refinance, a no cash out refinance, where they'll just keep the loan as is behind your new loan.
Okay.
You get one refinance, and anything beyond that, if you want to continue to refinance, you would need to pay off the loan.
Okay.
But you can do one refinance with CalHFA without having to do that. Or if you just kept it for 30 years, at the end of it is a 30-year term. So at the end of the 30 years, it would be due and payable.
Okay.
Or lastly, you could pay it off whenever you want, but I don't know why anyone would do that. We do not recommend that, because there's no payment on it and there's no interest rate on it. It's just money sitting there. If you have that kind of money laying around, it's better served elsewhere.
What would you do? So say you hold on to it for 30 years and they say, okay, well, you borrowed $100,000, now you owe us $100,000. Is that how it works? That you just have to pull $100,000 out of your house or something?
I mean, essentially, yeah, because your loan that you're in would be paid off in 30 years as well. So your home would be paid off except for this loan. And then, yeah, you'd just be refinancing for $100,000.
Okay.
Yeah.
Yeah.
Yep.
So what should people do if they want to find out if they qualify? And also, one other question, I'm sorry, this just popped into my mind, but are the interest rates any different on this loan, or are they pretty standardized?
They're pretty good. I was looking online today, and they had the Dream for All at 6% for a 30-year fixed.
Yeah, that's great. Okay.
Yeah.
That's right in line.
Yep. Oh, yeah, we got to talk about a couple strategies real quick.
Yeah.
We do have the process to apply as well. Maybe we're running out of time on the strategy part. We can get into that
the
more.
strategy you got to reach out to Jason for.
I would say let's do the process to apply,
Yes.
and then I can discuss strategies with the client. Our process to apply, get pre-approved with a CalHFA approved lender. That would be me.
Jason.
JMJ Financial. We can do that for you. It's the same process as always of getting pre-approved. You'll want to get going on that if you haven't already, because like we mentioned, the portal has opened today, and you have 3 weeks to get your application into CalHFA. Your lender will let you know, hey, you qualify for this program, or hey, you don't. They will issue a specific Dream for All pre-approval letter to you.
Okay.
You do need to take a 1-hour Dream for All course, which your lender can direct you to as well prior to. So that's just 1 hour. And then you'll go onto the website, create an account, and you'll submit your application with your photo ID, your driver's license, proof of citizenship. If applicable, if you have proof that your parents don't own a home, your Dream for All pre-approval letter, etc. And then you go into the lottery system.
Okay, and so since the portal closes on March 17th, when do people find out? Do they find out if they're lucky on March 17th?
You know what, they haven't, I know, they haven't announced yet when they're actually doing the drawing. I imagine it'll be very shortly after the portal closes.
It should totally be on St. Patrick's Day, but
that would be good.
I don't make that decision.
Yeah, I know, right? Yeah, there'll be a lot of possible celebrating that day.
Yeah, how quickly do people have to find a property once they get
They have 90 days to get into escrow.
Okay.
And if they haven't gotten into escrow at that point, then theirs expires, and their voucher would go to somebody on the wait list.
Oh, wow. Okay.
Yeah,
So
because there would be a wait list as well.
So
Yeah.
really, and we like to point this out, if you're looking for a home, like step 1 is get pre-approved regardless, whether you're doing this program or not. But step 2 is then you need to like be looking at properties. So if you need to identify a property within 90 days of acceptance, you really need to be starting to look now.
Yeah. You have 90 days to look. You have a 60-day escrow period, or up to 120 if it's new construction.
Okay.
So all told, it could be a little bit longer. But yeah, that's the basic idea, is be on the lookout, get into escrow within 90 days once you have that voucher secured, and then you should be good to go.
So reach out to Jason if you want to find out about the strategies and getting pre-approved, whether it's for this program or just in general. And then reach out to me if you want to go house hunting.
Absolutely.
Thanks so much for watching.
Awesome. Thanks for watching.